Good afternoon to everyone. I'm hoping you're all fine and, like always, ready to take a course of today. I welcome you all to yet another session of taxation. Last time when we have met, you people can recall we've completed ourselves with the chapter number 4. We started off in chapter 5 on capital allowance and did spend some time on, but mainly we will be spending our time on to chapter 5 today. Let's connect ourselves to the board to have an idea on what part of the chapter 5 we have finished so far so that we can start the course of today. The board is connected and here we are. This is the whole board explanation of the last week. Capital allowance is a real difficult topic, real lengthy topic. We have started this off by getting to know what basically the capital allowance is and the pool, general and special. As the name suggests, pool, it should pool up all the investments in it so that in the end, the totals can be used to apply the respective rates of depreciations with general pool takes 18%, special rate pool takes 6%. All of those investments into plant and machinery are pooled in. If any of those being disposed, we take them out. So that the net figure we have found it out can be used to apply the rate of tax depreciation to it. Almost everything is pooled in general, except few items. And those items were being talked about: a car that emits more than 50 grams, an asset within which an owner has a private use, and short life asset. Other than these three, everything fits into a pool, which is also called as general pool, main pool. While special rate pool takes hardly few special items, integral features, a car that emits more than 50 grams, thermal insulation, and long life asset. Then we started off by getting the idea of the first type of allowance, AIA. Rate of the depreciation was 100% up to £1 million of qualifying investment. Qualifying investment takes almost everything except cars. How to? Then I have been able to make lots of cases. That was the first most case. When the value of an investment less than to that 1 million mark, the whole is fully claimed. But when the same was valued more than to, maximum 1 million could have been claimed. When you acquire two assets, you must have to pool and match it once with 1 million. And when the assets are of two different kinds, special rate pool type of asset, general pool type of asset, you must have to claim the AIA one after the other. And the order that we have developed that gives us the more benefit of AIA was the one within which you match the AIA with the special rate pool asset first and the general pool asset after to it. When the period of account is long and short, the allowance limit needs to be prorated, time apportioned according to the months of the period. Like 18 months in one case, you people have seen me assuming, in 5 months in the other case. And finally, then we came to apply this into a pro forma. You people have seen the nice way of organizing the pro forma, and that we will do it for a number of times today. Additions not qualifying for AIA takes cars. Those will qualify. We go and write them into this column so that we match them with the AIA amount. Any amount that falls above to that mark, we go to throw it into a pool, which later attracts the 18% allowance over to it. And that is where the course of the last week was finished. A little bit of recap with this. Let's finally start the course of today. The next type of allowance we are heading towards is called as first year allowance. This allowance has a limited use. It's not as important as the AIA was. It's not as applicable as the AIA was, but still an allowance which will be tested, and we should know when and how to apply. 100% only on zero emission car, provided the condition is the zero emission car has to be a newly purchased. Yeah, if the car is the used one, purchase second hand, something else to be done, we will talk about that. But this one will be the one will be qualified for first year allowance. 100% only on the zero emission car, the one that's been newly purchased. Like there is a zero emission car being purchased, say for 10,000. And to add this is the new one. So I will come to claim first year allowance at the 100%. This is the allowance that we have ended up claiming, and the case is ended. Because we are not left up with any tax WDV, so the consequence of that will be finished into that year itself, and no further consequences you will expect to see in the next years to come, since in the first year this car is fully depreciated. What if the period length is less than 12 months, more than 12 months? This will not be time apportioned. You will not be able to multiply this by 5 by 12 or 18 by 12 as you were doing that for AIA. AIA is time apportioned, FI cannot be. Okay. What if the zero emission car, the one that they have purchased, is the used one, new or the used one? If it is a new one that you just have seen, first year allowance at the 100% will be applied. But if it is a used one, then we will come to apply a written down allowance at 18%. And it becomes a part of general pool. So that clarification is also been done, that if the car is the used one, then must have to claim the written down allowance at 18%. But if it is a new one, we will come to apply as what we are understanding right now. It has fully been depreciated in the year of purchase itself, so no further allowances in the next year you can expect to work on. Even if the length of the period is 5 months, say 7 months, 8 months, 9 months, 12 months, 14 months, 17 months, I will just have to do this. I will not be able to prorate this into 8 months, 9 months, 4 months, 14 months, 18 months. I will not, since FI cannot be time apportioned. That's first year allowance for all of you. See what's been written over. First year allowance is available at 100% only on the newly purchased zero emission car. Good. No allowances therefore subsequently be available as the car is reduced to zero itself in the first of its year. Common sense. Cannot be time apportioned if the period of account is long and short. This I already have told. Yes, if the car is a second-hand purchase, then the written down allowance 18% will become applicable to. So all what you are watching it, I even have been able to explain that to you. Like I said, this allowance is not as important as the AIA is, because this one is limited to only one place, and that place is newly purchased zero emission car. But AIA is applicable to every investment. So every question that you will do, AIA will be a part of that. First year allowance will be a part of it or will not be a part of that. That has no guarantee to it. Application 2. Let's go to work. This one to see what this has to offer. Wahab commenced on trade on 1st of June 2021. If provided plant and machinery he has acquired, office furniture, used car emitting 43 grams, new car emitting 0 grams, second hand car emitting 0 grams. 3 cars. These two are zero rated, zero emission. First one is a normal car, standard car. 0 to 50 standard, more than 50 high. Zero emission car has to emit 0. This is the main debate. But this type of car you also have seen before in that question. So the treatment of this car, the same as above, I have done that for standard emission car. So this will require me to prepare a same proforma as I was preparing it before, the column of AIA. Okay. And I can also write that oblique FIA. The same column can be used for first year allowance. The same column can be used for first year allowance, so it's better to write that as AIA oblique FIA. The next will be general pool or main pool, and the last one will be allowance. This other way, this could have been organized. We'll start off with opening balance. The opening balance is not given. Fine. And then we take those additions qualifying for AIA and not qualifying for AIA. We'll start off with not qualifying for AIA. Then we will take qualifying for AIA, not qualifying, and qualifying for AIA. Now this will take the car that emits standard emission is 43 grams. And this take the car that emits 0 grams, but it is a second-hand one. And both of them will go into pool. The value of that is 4,500. I will go to write that directly in pool. And the other one will also go into pool. But the 0 emission one, which is a new one, will go into FIA column. See, this treatment is nothing new. You people have been there in the last course and you have seen me treating, and I'm just doing the same thing over here. Check this out. See, this car was treated the way as it was treated in previous question. But now you have been able to take one more car here based on to this talk, that if the car is a 0 emission and a used one, you take them into pool. So that's what I'm doing. Qualifying for AI, you will take plant and office furniture. Plant and office furniture. Both of those values are general pool items. So I will just go to add the total 900,000 and 430,000. 900 plus 430, the figure has to be 1,330. I will match the AIA with maximum I can do, that is 1 million. You know that. Any amount that we have found in excess over 2 will be transferred to the column to which it belongs to. That column is pool. See, this question will revise on a rolling basis all we have done before. And there we will come to treat the first year allowance, or you even can take that low emission car. The car 18%. Let's go to find the total. 4,500 from the first car, 2,300 from the second car, and 330,000 from the third car. The total becomes 336,800. The written down allowance at 18% onto that will be 60,624. 60,624. And then comes the car that emits 0. The cost of this car is 5,500, and I will be able to use this column and will do this to end the whole story. All of this instantly being transferred to outer column. That's the end of this question. Now, if you compare this question to the one we have done before, hardly there is one difference. that I have been able to incorporate 2 zero-emission cars in it. And the one that was the used one will be treated the same way as the standard car is emitted. And the one which is a new one will attract first key allowance at 100%. And the way to position it is in the last part of the question, right in the column of FIA. Gradually, I will try to incorporate question by question more and more items in. This is 106, 6, 124, 33, 6800 minus 60624. The answer turns out to be 276, 176. Okay with that? No problem whatsoever. Let's try to zoom out this and place this in front to see only the newish part in it, because the rest of the part, 80 to 85%, what was done in that question, it has been repeated. The treatment of AIA is totally a revision. The treatment of standard emission car is totally a revision. Just these two highlighted figures is what just we have understood. Both of those cars are emitting zero. Electric powered cars these are. But noticeably, this one was the used one. So used car is treated the way the standard emission car is treated. New zero emission car to be treated the way we have just understood. And the difference is quite much contrastable. The written down allowance to be applied, 18% of that has been the same talk as above. So gradually, the next question you will see me doing, I will try to incorporate some further items. But to start the question, and majority of the stuff in the question will remain the same as always. And by the time this chapter will finish, you'll become automatically quite much pro at managing which column, which row will have to take what. Next up is written down allowance. And this written down allowance is something that we already have been able to understand. Written down allowance, WDA, written down allowance, WDA, written down allowance. So written down allowance is available in two denominations. First, in the form of 18%, and then secondly, in the form of 6%. General pool assets, and that will be special rate pool assets. So general pool assets, special rate pool assets, they attract 18% if it is general, special attracts 6. And that you people already have seen me when this whole topic started. Even today, I was recapping that the general pool takes 18, special rate pool takes 6%. See, over here also, written down at 18% when the pool is general, 6% when the pool is special. It is available on text written down value year after year on reducing balance basis. Just the way in accounting studies, you come to apply the rate of depreciation to the net book value year after year, we will have to do the same. Closing of this will become the opening of next year, and you will keep on claiming the written down allowance year after year. See, this closing of this year will become the opening of next year. And then you will try to incorporate lots of newish things from that year itself, like these things. And whatever the total that you will get will come to attract 18% year after year, year after year, year after year. See, plus any purchases on which the AIA is not available. So these are those purchases on which the AIA is not available. We are adding it in. AIA is not available. Plus any of those purchases which are not covered by AIA. So this was eligible but not been covered by AIA, since the limit of AIA is 1 million. This was not covered. So I came down to also add this in it. So word by word, There you can see they're trying to explain, but we already have achieved that by attempting one or two questions. So we know the way that this written down allowance has to be applied, what it takes in it. The closing of this will become the opening of next year, within which you will come to add all of this stuff. Those additions, those are not qualifying for AIA. Those additions, those are qualifying for AIA, but what not been covered by AIA. And ultimately, whatever the figure we get in the end comes to attract the written down allowance 18% to it. What is tax WDV? How do you calculate the net book value of an asset in accounting courses? Cost less accumulated depreciation. So tax WDV will be even the same, cost less accumulated capital allowance equals to tax written down value. That's being explained over here also. Tax written down value is the total of all of the expenditure in the pool after deducting allowances being claimed to date. So it's cost less accumulated capital allowance. That is tax WDV. Now, written down allowance is not available in the year of disposal of asset, also not available in the year of cessation. In a year, if an asset is disposed, or in a year, if an asset is, or if the total business is seized, in that year, the allowances will not be available. So we have to make sure before we come to claim the written down allowance on this total, I will have to make sure an asset being disposed must be removed out first. So that this total that we have found must be out of this, must be free from this. So we will have a formal discussion coming to our way in relation to disposal of asset, where you will exactly see me deducting the effects of disposal first to arrive at this answer, which then attracts the written down allowance at 18%. Yes, if the time period is long and short, the written down allowance will time apportion. Like the way the AIA limit was time apportion 5 by 12, 18 by 12, the written down allowance will even go to time apportion. So we have three allowances. AIA, written down allowance, these two will time apportion. FIA will not. First year allowance will not prorate. WDA and AIA both will. Whatever you see on this side, copied over here. So do not need to read this side. Just the difference is the difference of the rate. So all of the stuff that was written there, by anyhow, we've been able to apply it already for about 2 or 3 times. So you've seen the process of taking those additions in the first place, adding this effect into it, and then claim the written down allowance onto that is the process which you have actually been able to apply it. Rather, do you go and read the text, you already have seen the way the written down allowance, one has to make a use of it. Let's go to solve the application number fed very next to. Graham commenced in trade on 1st of June 2021. His trading profits, adjusted for the purpose of tax but before capital allowances, are as follows. So they say that the profits are all adjusted, but one thing that they have not yet done is the deduction of capital allowance. Year ended 31st of May 2022 and year ended 31st of May 2023. On 1st of Jan 2021, Graham acquired a plant and machinery of 1.2 million and a new motor car with the CO2 emission of 43 grams. Calculate the Graham's tax adjusted trading profits for the both years. There are 2 years involved, so we'll go year by year. They want us to adjust the profits, and we will have to subtract the capital allowances from the first and the second year, and we will go with the first year first, which is 31st of May 2022, ending it on. So I will have to once again the column of AIA has to come in front, the pool, and the column of allowance. Opening balances are not given because they have just started to trade. So we'll start off with additions, not qualifying for AI. And those are qualifying for AIA. This will take definitely a car, like always the case. We will go to write this car somewhere over here. This is 11,000. And then this will take a plant, which is 1.2 million. I will be able to match the AI with the maximum of 1 million. This will be transferred to the column to which it belongs to. And then we will be able to claim the written down allowance like always we have. This will be 21000000, 211000. That is about 211000. The 18% of that has to be 37980. Should be the figures to write it to end the year with. This is 1037980. 1037980. 1037980. Yeah, good. And 211000 minus 37980 turns out to be 173020. That is the closing at the end of the first year we have found, which will become the opening for the next year. I mean, what's so new in this question that you are watching it doing with me? A repetition stuff. And that's what I'm telling you, that you'll become quite comfortable at using this pro forma of computations, the column of AIA, the way that we pass through this figure to this column and match it up by, and the access transfer to this column. Year ended 31st of May 2020-22. Now we are getting into the next year. The closing of last will become the opening of the next year. And the cycle of that will continue as. Well, the next year is not the year within which there are any purchases going on. So opening balance on the 1st of June 2022 will be what? It starts off with 173020, 173020. And this is not the year of acquiring any assets, so AIA will not be valid. We will just come down to apply written down allowance year after year this way by. The 18% of that will be 31144. 31144. So 31144 minus 173020. The figure turns out to be 141876. 141876. It's 31144. So if calculations have not been an issue anywhere else, this is the way that we had to get that answer, and we've got. And we are not missing it out onto anything. No, we are not. So we have got those figures ready. I can subtract the capital allowance, which is 103,7980. 103,7980. And it is 31144. Okay with that? So 193,000 minus 103,780. It's 945,020. 1259 500 minus 31144. That's about 12835,6. Seriously, that question was the one that I could have simply jumped over to, because nothing we have seen newly in it. Like always, we start off with the AIA being matched up with, and any amount that could have not been, we transfer it to the column to which it belongs to, and then we come to claim the written down allowance. The closing of last becomes the opening of next year, and we continue to do the same thing on a reducing balance basis year after year. Once those figures were ready, I came down to subtract it to make these figures ready after the capital allowance. The figures are 945,020 for first year and 122,835,6 for second year. Then comes the short or the long periods. Short or the long periods. And we already have had a debate on it. But now formally we can try to take this on this page. When the period of account is either a short one or a long one. Short period is when the length is when the duration is less than 12 months. Long period is when and the duration is more than equals to 12 months. So in the cases, once again, I can write that in big letters. AIA and written down allowance, they are prorated. They are time apportioned. But what does not time apportion is first year allowance. Prorated, and this one does not. Okay, so you will not forget it now. On this page, in big letters, I have been able to write which one has to prorate, which one does not have to. And that also has been said on the top of this page. AIA and WDS are time apportioned. FIA cannot be. The definition of short period, although we know from the past, but still they're coming to explain that again and again. Application number 4 has a period, the length is 15 months. Application 5 has a period, the length is 9. So I can do the one of the two, and then the number of months can be any. You can do that the next one by your side later on. I can take the application number 4 to work. Michael commenced in trade on 1st of September 2021. His trading profits adjusted for the purpose of tax, but before capital allowances are as follows. Provided 15 months year ended. On 1st of December 2021, he bought the plant and machinery for this much, and motor car with the CO2 emission of this much. So question looks to me like the same one as above. The difference is only where this was a question within which we had a year. This has got the 15 months in it. So I will still have to go and find the answers after deducting the capital allowances. So a same sort of a pro forma I have to prepare, so I can try to copy and paste this pro forma to save quite a bit of a time. and then can try to edit some figures into it. First of all, it's ending it on to 30th of November 2022. Yeah. Then the figures are not the same as what. Yeah. Okay. 1350 000 and the value of the car is 8900. Good going. This period has got 15 months in it. So what I will do in the first place, I will try to scale this limit of 1 million up to 15 months mark. Scale this up to that 15 months mark. That's going to be 1 million multiplied by 15 divided by 12. That's about 1250 000. 1250 000. This is the limit that now I will be able to use over here. Check this out. This is 100,000. A transfer of that to this column. What is so special about this case? You can see the specialness in it. 1 million, usually we come to match. We've been able to match 1.25 billion. All because of this. Time apportionment. It takes the balance of that 108900, 8900 plus 100,000 multiplied by 80. Now, when I will go to multiply this by this, I will also be able to multiply this written down allowance with that 15 by 12 factor. That answer turns out to be 24503. There you go. This is what we're supposed to do in the case when the time apportionment is required. Just take the good care of it. So 108900 minus 24503, the figure turns out to be 84397. 1250 000, the figure turns out to be 1334397. 1334397. The closing of this will become the opening of the next year, and the same cycle will continue. It's 1st of June 20, no, that's rather going to be 30th of November 2022. First of December 2022 to 30th of November 2023. The closing of last will become the opening of next year. Next is a year, so 84397, and I will be able to apply written down allowance 18% to it. 84397 multiplied by 18%, that is going to be 15191. There you go. 84397 minus 15191, the figure turns out to be 69206. So if computations have not been an issue, we've been able to get the answer for the 15 months in the first place and then a year in the next. Simply, these figures can be deducted from this side to get those answers. 1334397, 1334397, and the 15191. The next question has got 9 months in it, and that you can keep it for you to solve. The difference of that will only be 1. Instead of using the 15 by 12 factor, you'll be able to replace it with 9 by 12 factor. Nothing else. More than that will change. So that's the case we even are done. Small little thing we have to understand, we take one question on that. I mean, it becomes very difficult for a student to learn if I first of all give you the whole of the explanation in a one go and then can apply all in one question. Better is what we do a little thing, we do application on that. 90 to 95% what we have done in this question is a repetition, except only this part where you have been able to scale these figures up to 15 months mark. The total for the allowance for the first year is wrong. Okay, whatever is correct, you can correct. 1250. No, this figure is not right. That's what you were talking about. Okay. So 24503. Whatever the answers, the total are, you can correct it. 1250 plus 24503. This is 1274503. 90 to 95, in fact 95% what we have done in that is the whole of that reputation stuff, except the only attention that you had to pay was towards this, that the limit of AIA being stretched up to 15 months mark. So we have started using 1.25 million instead of 1 million. And here also you can see visibly 15 by 12 factor being applied to written down the lumps. Well, the rest is all the repetition. Considering the toughness of this topic, sensitivity of this topic, we are working the questions where 90 to 95% we come to revise on a rolling basis, and that makes the whole process for us to gain a good grip over to this topic. And just for about 5% of the portion was a little new in it, and we've been able to also understand. Remember, 2 of those allowances will have to prorate. AIA and WDA, FIA will not. Sale of the plant and machinery. That is going to be our next talk. How to deal it with when there is a disposal of asset. Let's go to get an idea first before we take a question. Sale of the plant and machinery. Sale of the plant and machinery. So how to deal it with? Suppose we are having a column of AIA like normally we have, and then we have a column of general pool and allowance. We normally start off with opening balance. Remember? Well, this is how the way we've been organizing those columns as of yet. Any asset, the one that you have purchased, you have seen it the way we come to record plant purchased, we come to record it into this column, and then we come to claim the AIA against. Any amount, we come to transfer it to the column to which it belongs to. If any asset is disposed, like I said, in the year of disposal, the capital allowances cannot be worked onto that disposed asset. So what I will do, if the plant is disposed, in the first place, I will come to first of all remove it. Before we can claim the written down allowance at 18%, we will have to come and remove And then we will have a chance of working the written down allowance onto the remaining balance. This needs to be removed because in the year in which an asset is disposed on this balance, the allowances cannot be claimed. So we must have to filter this amount out so that the net balance we will find to claim the capital allowance at will already have taken that effect out. This figure is without the figure of asset being disposed. And this deduction must have to be achieved by taking the lower of two things. The cost and proceeds. Whichever is lower, we will take it. Proceeds will be the lower figure because when an asset is disposed after several years of its use, the market value of an asset falls, not the same, the price that was once paid. Today, if I decide to sell up my laptop, I will be able to sell this laptop for a very small value. But when it was acquired, the cost of that was so huge. So usually the proceeds will turn out to be a lower figure. But you never know. The cost can even be at times the lower one. So you must have to remember that the deduction has to be achieved by taking the lowest of two, cost or proceeds, whatever. That's the discussion in regards to the sale of plant. It must be deducted from the pool by taking the lower of the proceeds and the original cost. Disposal proceeds are deducted from the total tax WDV plus all the additions brought into the pool. Written down is then calculated on the remaining balance. As you can see me demonstrating, written down allowance is going to be worked on the remaining balance. That is exactly the position where the disposals will be embedded. Can't be deducting it after to it. Needs to deduct it before claiming the written down allowance at the lower of two things, the cost or the proceeds. Now we can do this application number 6 on that to formally take a question on that. Paul has owned and run his business for many years. He prepares the account to September 30th. During the year ending it on September 22, the following transactions have taken place. 15th of December, purchase a motor car with the CO2 emission of 25 grams. 21st of December, sold a piece of plant for 4,500. He had paid 13,000 for this when he acquired and purchased the plant for 71,000. So question has got almost the same stuff we've been doing, except the one thing is not there, which has not been the part of any question before this question has taken in, is the topic of a moment, sale of the plant. Alongside, they provide us to all of us with the opening tax WDV. They want us to calculate the capital allowance, and we easily can. Application number 6. A column of AIA, pool, and the column of allowance. So opening balance is given as 23,000. Additions qualifying for AIA and not qualifying for AIA. Additions not qualifying for AIA and addition qualifying for AIA. Sold a piece of plant for 4,500 when he had paid them. Okay, first of all, let's deal with the plant being purchased. The plant that they have purchased was for 710,000, and the car that they have purchased emitting 25 gram, that's like a normal car. We will come down to write it over here. Sorry, in the next column. And then we will be able to claim AIA the maximum that we can claim is 710,000. Is it? Now, normally we have a tendency to work the written down allowance very next to. But now because the question involves disposals, so I will have to take this into after. First, I will deal with disposals. So just the way you have made the heading of additions, I will go to make the heading of disposals now. Within which I will come down to write the plant disposed for 4,500. And I will have to subtract that from the pool by taking the lower of two things. The lower of two is definitely this 4,500, not this. There you go. That is what one has to do. So you see a small thing we have to do it. We take a whole question and we come to revise 95% of the same stuff and then come to incorporate the topic of a moment. 23,000 plus 10500 minus 4,500, that's about 29,000. The 18% of that has to be 5,220. That's the end of this question. This was the only focus of ours, that you must have to bring the balance of pool down by the effect of disposal at the lower of two things, the cost, the proceeds, so that this amount on which you can claim the written down allowance should be free from what you have disposed. Fine with that, no problem, no such issue. Within that, we are continuing ourselves with this discussion, cessation of the business. Now, cessation of business is in fact the sale of entire plant and machinery. This is just the one out of the entire business randomly disposed. Cessation of business is in fact the sale of entire property, plant and equipment. So how to deal it with the cessation of business, I can come to explain by once again a column of AIA, pool, and the column of allowance. There are in total 3 columns: AIA, general pool, and allowance. AIA, general pool, and allowance. Normally what happens, we start off with opening balance, then we take additions, or I simply can write to explain plant purchased in it. Plant purchased. But normally we have a tendency to record the purchase of plant in the column of AIA because we have to match the AIA very next to. But that is not going to happen in the year of cessation. Since in the year of cessation, the allowances cannot be claimed. Any type of allowance cannot be claimed. So any plant that has been purchased, we will come to write that directly into pool. Because we are not supposed to claim any AIA on that. So what's the point of writing this amount over here when later you do not have to claim AIA? So we go to throw this amount directly into pool, where we already have an opening balance. Good. You may have purchased 2 plants, 5 plants, 8. All of those purchases will be placed over here. Will be placed over here. And then we will be able to compare it with the proceeds. Since we cannot claim the written down allowance also, we cannot claim the written down allowance. Just whatever the total we have, I will be able to compare it with the proceeds to see if I'm ending up getting a figure of a gain or maybe a loss. So total balance of pool will be compared with proceeds of the disposal to see we have a gain, we have a loss. The gain is called as the balancing charge. And the loss is called as balancing allowance. Gain will be added into profits later on, losses will be deducted. This is what needs to be done. In the year in which the business is seized, nothing to be done. Just bring all of the stuff at one place. That one place is pool. And match the total with the proceeds to see if you have an overall gain or overall loss. Gain is called as the balancing chart. The loss is called as the balancing allowance. Okay with that? No such issue. That is exactly what we will come down to work into application number 7. They want us to calculate the capital allowance for the years ending 31st of August 2021 and the period ended 31st of Jan 2022. Application 7. Here we are going to work. Nancy has previously prepared accounts to 31st of August. She decided to cease the trade on 31st of Jan 2022. After a year of bad health, the following transactions have recently taken place. On June 30th, 2021, purchase a plant for £450 and plant being sold out, selling the plant for £450, the cost of that was 3,000. The lower of two has to be taken. And purchase the plant for £150,000. On the completion of the sale of business, Nancy received £6,000 for the plant and machinery. The tax written on value on the 1st of September 2022 was £14,000. So we will have to first of all come to investigate which year is a year of cessation, because the question involves 2 years. This looks to me like a year of 12 months. This looks to me like a period of August till Jan 31st. It's going to be September, October, November, December, Jan, 5 months. So let's go to analyze the years involved. The first is year ended 31st of August 2021. So this year, if ends on the 31st of August, the start of that has to happen on 1st of September 2020. And then comes the year ended. No, it's not year ended. In fact, it's a period ended on 31st of Jan 2022. We'll start the very next day, 1st of September 2021. September, October, November, December, and Jan, 5 months. So how many months we see in this? We can see 12 months in it. Obviously, it's a full year, 12 months, and we can see about 5 months into it. Okay with that? Yeah. And the date of cessation is in fact this date. This is the date that the business is seized. That means this year, when I will go to treat, I will just go to treat it normally. I will simply be claiming the allowances the way that normally I claim AIA, written down allowance. This is the year of cessation where I will be coming to apply this stock that I have just had. So let's get done ourselves with the 12 months first. So I'm taking this discussion in the first period ended 31st of August 2021. So I will have the column of AIA to write. I have the column of general pool to write. We'll be having a column of allowance to write. The opening balance is given as 14,000. The opening balance on 1st of September, 14,000. The opening balance is given as 14,000. And we will have to investigate. The sale of the plant was done in 12 months or 5 months. So in which exactly the period that this sale falls in, the sale of asset? 13th of June 2021. Oh, that falls over here. This is the place that the disposal of plant falls in. So I will just come to record this. In the first year, the way that normally we record, lower of 2 cost proceeds, deducting it from the pool. While this purchase of plant is generally in the last 5 months. Yeah, November is over here. So this year is over 14,000 minus 450, that is going to be 13,550. I will be able to claim the written down allowance at 18% to it, which is 2,439. Figure turns out to be 1,1,0,1,1,1. Oh, the lucky number, penta 5. The closing of this will become the opening of the next year, 31st of August 2021. The closing of this will become the opening of the next year, next period, in fact. Period ended 31st of Jan 2022. Now, this is the year of cessation finally. The opening of this year will be the closing of last year, which is penta 5. The column of AIA does not need to be prepared since it's the period of cessation, no allowances whatsoever we can claim. Any plant that they have acquired, we will go to place it into the column of this 150,000. The total turns out to be 161111. Normally, we have the tendency to claim written down allowance, but this time we will not go to. I will simply be able to claim written down allowance. No, that is not going to be the case. Normally, when a plant is purchased, we come to claim AIA. We are not doing it. Normally, this total, when we find, we come to claim the written down allowance. That's what we are not also. We will just come to compare it with the proceeds of disposal, which in this case is being given as 6,000. And this is going to work a huge loss balancing allowance. That's 155,111. 155,111. This is a loss, and we call it as balancing allowance, which later on I will be able to deduct it from the profits of accounts to get me the answer of tax adjusted trading profit. Now, this is what one has to do. Didn't I explain the same to you above? Plant purchase, we take directly into pool. Then we do not even claim written down allowance. We came to match it up with the proceeds to get either this or that. That's exactly what I was doing. Plant purchase, I did not claim AIA. Then the total, I did not come to apply the written down allowance. I rather have been able to match the proceeds with that to find me the figure of either a gain or a loss, which in this case was loss balancing allowance. All was written there back into lecture notes. When the business is seized, a trader can obtain a relief in the shape of the balancing allowance or a balancing charge. Balancing allowance arises when the pool balance exceeds over to disposal proceeds. And in case it will be the other way around, the balancing charge will arise. And that's being written on the top of this page also, that if the proceeds are less than to the tax WDV, it will be a loss to be deducted from the profits of trade. But when the proceeds are more than to the WDVs, charge will arise, which will be added into profits. And when both of those figures are same, no allowance, no charge will whatsoever be arised. how smoothly. We are almost done with, I would say, 60% of this chapter. And the seventh application we have attempted today. And all of those seven applications, they are bringing us back to the same typical stuff, AIA, return down allowance. Minor thing you come to include it in, the rest of the thing comes to revise. All whatever is written back into lecture notes, thoroughly we have checked, highlighted, underlined, and noted, and we are finishing it off. But you can check this out, how complicated is to calculate the tax depreciation in comparison to accounting depreciation. Two old typical methods, straight line reducing balance method, and too easy to apply. That's the tax depreciation that takes lot many things, and still many of things are coming to your way. Next up is motor cars. Now these motor cars are not new to us, because over the time we have seen plenty of cars already. Can't you see me treating the standard car in almost every question? We have treated a standard car, 25 grams. Check this out, 37 grams, 39 grams, 43 grams. All of these cars are standard emission, 0 to 50. So if now you come back to read this standard emission car from here, you will not be surprised to see that how will it be treated, because you people already have treated that out with me in almost every question. It goes to general pool, attracts the written down allowance 18%. No FIA, no AIA is applicable to such car. Didn't we see today the zero emission car? Remember the zero emission car? When it is a newly purchased, we take first year allowance at 100%. But when it is a second hand, we take written down allowance at 18. We have specifically worked a question on that before. And lastly, this car is called as high emission car. And that is the car which goes into special rate pool. So will attract the 6% written down allowance. And that we have studied also before while we were discussing this. What goes into special rate pool? Check this out. The car that emits more than 50 grams. Whatever effectively on this page is written, that's nothing new to our knowledge. But formally, we have been able to land ourselves onto this page and watching it. There are some other vehicles which we do not drive it in our normal life. Bulldozers, tractors, cranes, vans. These are the sort of vehicles which we do not tend to drive, but they are still called as vehicles, but they are not the motor cars. Therefore, the normal rules will be applicable to other types of vehicles. Written down, vans, lorries, tractors, bulldozers are not classified as motor car. They are treated as general plant and machinery. Means if the question provides us with van purchased, tractor purchased, lorry purchased, bulldozer purchased, we will just go to treat them up the way that you're treating any of the plant for AIA. You will come to bring the purchase of tractor bulldozer into this column and match the AIA with. You will be just be treating that type of vehicle to be like a plant and machinery. And normal AIA rules will be applicable to it like you used to apply to any other plant and machinery. Good with that? There is an application they ask us to do on the cars and we can do it. Although all of the content in this application is a revision. Calculate the capital allowance for the year ended 31st of December 2020. Application number 8. Johnson prepares to set account 31st of December. At 1st of Jan 2021, tax WDV of the pool was 47500. Following transactions have taken place during the year ending 31st of December 2021. On 13th of May, purchase a plant for 1.25 million. On 27th of July, purchase a motor car with the CO2 emission of 38 grams. And on 20th of September, purchase a motor car with the CO2 emission of, now that is a high emission car. First time coming into our place. 76 grams, more than 250. Definitely a standard emission, high emission car. So how many columns do I have to plan this time? A column of AIA, a column of general pool, a column of the allowance. Well, let's not forget, for the first time, we will also have to maintain a column of special rate pool. So there'll be 4 columns. Starting ourselves with AIA, general pool, special aid pool, and allowance. At 1st of Jan, the tax WDV is given. The pool starts off with 47500. There you go. And then we will start off with additions not qualifying for AIA. And additions, those are qualifying for AIA. And this will definitely take both cars, the car that emits 38 grams, the car that emits 78 grams, 76 grams. And plant purchase for 1.25 million. This will step in. Plant purchase for 1250 000. This will go over here, 38 emitting car, 10990. And this will go over here, 17500. So I will come to claim AIA with the way I usually come to do it. 250,000. We'll make a transfer. To the column to which it belongs to. And then we'll come to claim the written down allowances at the rate of 6% for the first time becoming a part, and then at the rate of 18%, upon which this question will come to an end. 18% on this, 6% on this. So 17500, the 6% of that has to be 1050. This is 250,000 plus 10990. It's 260,990. 46978. Okay with that? 46978 minus 260,990. The figure is 214,012. One zero five zero plus 46978 plus 1 million. See what is so new in this question. You all can Be honest to yourself. That's the way this whole topic is designed. Questions and questions and questions. And by the time this chapter is coming to an end, probably in the next 45, 50 minutes or an hour of, you have seen that process on rolling basis so many times being revised. Starts off with AIA matching. Any figure that you find in excess over 2, we come to transfer it to that place. And then you come to claim the written down allowance. First time, what has been added into it is a special rate pool. And the way the special rate pool is treated, the way that we treat the general pool, 6% rate of allowance has been used instead. Over to it. What's next? Asset with the private use of the owner. Asset with the private use of the owner. Now, what is this little concept, asset with the private use of the owner? Asset with the private use of the owner. Asset with the private use of the owner. Asset with the private use of the owner. So I suppose I'm working onto a question within where we have a privately held asset. So this is the way we have been organizing the columns for all those questions in the past we have done. This is how the way we've been organizing. This is how the way we have been organizing all of those columns. There we start off by having an opening balance. If just purchase a plant purchased for a value of 1.3 million, we come to match the AIA with. So I will be able to match the AIA with. But now we came to realize that this plant has been used 30% privately used. 30% privately used by the owner. You should not be forgetting that the private use of the owner is a disallowed expense. Last week we were talking about, while we were discussing allowed, disallowed expenses, private use of the owner is a disallowed expense. Now, when I will come down to claim this depreciation, I will be able to only claim a business portion of it, which is 70%. I will be only be able to claim the business portion of it, which is 700,000. Although in this column, we have been able to write off the whole 1 million, but when it comes to claim it in a column of allowance, we will be able to shift only the business portion of depreciation, because that portion of capital allowance can only be claimed. Private portion is not allowed. That is a new thing, you're learning it into this question. Now, whatever the amount that you are left up with, 300,000, this will be transferred to the column to which it belongs to. Usually we come to drop this value into this column, usually, but that's not going to be the case. Since any asset in which the owner has a private use in, we must have to columnize it separately. So I will go to maintain another column within which the owner has a private use in, and I will be able to write it. This is another thing that you have seen for the first time. So this 300 will be dropped into its own column. Usually we come to drop this into a column of pool, but now when an asset has got a private use in it, we must have to columnize it separately. And by columnizing it separately, we will still have to claim the written down allowance at 18%, like normal, 300,000. The 18% of that will be 54,000. Then once again, when I'm going to shift this amount to outer column, I will be able to shift only the 70% of that, which means 54,000. 70% of that is 37800. 37800. So this is what you were here to learn. We can now take a very formal question on which we can take this whole thing back into a talk. First of all, any allowance that you will come to apply, it will be restricted. Only the business portion of allowance will be transferred. And that asset within which the owner has a private use in it needs to be columnized separately. So I did. It is beneficial to match the AIA with an asset first within which there is no private use. Because if this asset did not have a private use in it, I would have transferred the whole 1 million over here. But with that private use was involved, I have been able to restrict it to 700,000. So part of the AIA is vested. Now, if the question involves two assets within which one asset has a private use in it and the other asset does not have a private use in, then we will have to match the AIA with the normal asset first, so that we cannot waste the AIA this way. Yeah, but the only asset if you have acquired within which the owner has a private use in it, so you can't do anything except this. Okay with that? Similarly, when this asset will be disposed later on, you will end up working the same balancing allowances or balancing charges over to it, the way that you have done previously. Balancing allowance is a loss, balancing charge is a gain. If tomorrow this asset will be disposed, so I will be able to match the tax WDV of this plant to its proceeds to find me a figure of the allowance or a charge. All what I have just talked about is from this page. Let's go and have a look. Asset with the private use of the owner. Asset for the private use of the owner. Asset with the private use of the owner. Asset with the private use of the owner. If an owner has a private use of the business asset, if the owner has a private use of the business asset, the portion of the allowance attributable to the private use cannot be claimed. Private use of the business asset by employee will not restrict. Yeah, if employee is having a private use in it, that should not restrict. Separate column is maintained for each and every asset that is disposed, that the owner has a private use in it. Separate column is maintained for each and every business asset in which the owner has a private use. That's the reason why you people have seen me creating a separate column. It is tax beneficial to match the AIA with the general pool asset first in priority to the business asset within which the owner has a private use. This I also have told you about. And yeah, the balancing adjustments will arise on the disposal of such assets, and the balancing allowance arises when this happens. Balancing charge arises. You know when the balancing allowances and balancing the charge arise. You people already have seen me explaining what is balancing allowance and charge. And this is the question in which finally we will come to formally apply it. Application 9. Now, Melissa runs a small business and prepares accounts to 30th of April. At 1st of May 2021, the tax written on value on the pool was 30500. The following transactions have taken place for the year ended 30th of April 2022. So they have provided to all of us with all of that data once again. Purchasing a plant for 1.26 million. 23rd of August, purchase a motor car with a CO2 emission of 39 grams. And that looks to me like a standard normal car. 27th of December, purchase a motor car with a CO2 emission of 41 grams. 30% private use by the Melissa. And that is what they've tested us on for the first time. Who is Melissa? Is she an employee or owner? No, she is an owner. So her private use is going to be a problem. Purchase a new motor car with the CO2 emission of 0 grams. Oh, that's zero emission car, and that's new one. So this will attract first year allowance at 100%. We did understand that. In fact, the first topic we understood today was the zero emission car, newly purchased, FIA at 100%. So how many columns do we have to plan to prepare? AIA has to be the first one. AIA/FIA has to be the first one. General pool has to be the next one. Do I need to maintain special rate pool? No, I don't see any special rate pool asset over here. But certainly we have to maintain a spare column for this privately held car and allowance, 4 columns. Here you go. AIU to start with. Then we will have general pool. And then we have the car and the allowance. Opening balances are provided. The opening balance is 30500. 30500. And we have additions not qualifying for AIA, additions qualifying for AIA. Not qualifying for AIA and qualifying for AIA. 1260. This is plant. Car with the CO2 emission of 39 grams. This is 19,000. Will go into this column. The second car that's emitting 41 grams is a privately held car. So I will go to write that into its own column, which is 9,000. And I can mention that up there for my reference, 30% being used privately. Okay with that? While this first one, we will be using it later on because FIA at 100%, we come to use it into the most last. So we will look into that in a while. Let's match the AIA at 1 million. We'll transfer it to the column to which it belongs to, which definitely is the column of pool. Repeating. This treatment of AIA. Then we will come to work the written down allowance at 18%. Do we have any disposals in this question? No. The total for this side will be what? 260,000 plus 19,000 plus 30500. That's going to be 309500. 309500. The 18% of that has to be 55710. The 18% of that 9,000. The 18% of that is 1620. This car has been used privately. So when I will go to shift this allowance to this column, I will be shifting it by 70%. 1620, the 70% of that plus 55710. This is going to be 56844. 56844. See, when the car was being put into a separate column, we still have claimed the written down allowance, but the only difference is that when we are shifting this 1620 to this column, I'm taking us 70% of that. So whatever the 70% of that is answered, plus this equals to this. And then finally, that zero emission car, which is 10900. First year allowance at 100% will be 10900. There you go. What do you see exactly so big in it that 95%, even more than 95% of the content of this question is the same as what we've been doing it, except this thing was newly inserted, the treatment of privately held license, separate column, and this thing with that. The rest is the total revision. Short life asset to come to our way, small pool WDS structures and building allowances. We will be able to finish it. Plenty of time we have in the course of 2 days being left. We will go and take a break of 10 minutes. And after, once you will come to see me, you will come to see me completing whatever is left into this chapter. So stay tuned. I will see you in about 10 minutes to continue the course. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. Let's straight away get ourselves into talk of small pool WDA. So, what is this small pool WDA, and what makes us to say that the pool is a small? Now, see a situation where this is a column of AIA, pool and allowance. We usually have a tendency to start writing the opening balance, this is from where we will take a start from opening balance, general pool, plant purchased, we match up with the AIA with the maximum of excessive amount, we come to transfer it to the column to which it belongs to. And then if there has been a disposal of plant disposed, we come down to remove that from the pool to get. And this is where now the small pool WDA will become applicable. Says that if the balance of pool turns out to be any balance less than 2 or equal to 1,000 pound, which in this case, then we will rather go to claim written down allowance at 18% to it. We can come to apply small pool WDA. And by applying the small pool WDA, this will fully be shifted to the outer one. That is small pool WDA. That if the balance of pool falls below to that mark of 100,000 or equal to 1,000, then the whole of that balance will instantly be transferred. Possibility is only when this condition is satisfied. Before claiming any allowance, if the balance of pool turns out to be a balance less than to 1,000 or equal to 1,000, the whole of that allowance will immediately be transferred. A small pool WDA. Okay with that? This applies both to general and special rate pools separately. Small pool WDA applies to both the pool general and special if and only if the pool balance equals to or falls below 1,000 mark. This limit that they have provided to all of us will be time apportioned if the period of account is longer or shorter. Balance of the pool is fully written off immediately. Immediately we come to write it off. Good with that. This is small pool WD. Short life asset. Short life asset. SLA. Short life asset. What makes an asset to say short life? The useful life is less than or equals to 8 years. An asset is said to be a short life, the life of which is less than or equals to 8 years. The life of which is less than or equals to 8 years. So considering the case, AIA, general pool, like the way that we have those columns with us. Opening balance, the way that we normally have. There has been a purchase of plant Normally, the purchase of plant is a pool asset, it's a general pool asset. We will come to match it up with its AIA in the first place. Whatever the amount that we could have not possibly been matched, we know that we come to transfer it to the column to which it belongs to, which is general pool. It is the plant which can have a life of 20, 25, 30 odd years, 10 years, but they expect to use that out for the next 5 years. They expect to use that for the next, say, 5 years. So they will come to make an election to classify this plant as short life, which in reality is not a short life asset. It can be used for 10, 15, 20 years, but they intend to use that for only for 5 next years. So they need to make an election to classify this as short life. And upon classification as short life, we will have to depool it. We will be able to depool it. I'll be able to maintain its own column, and will be able to transfer this balance to the column to which it belongs to. Which column is this now? This thing is called as depooling. This is called as depooling. This is called as depooling. This is called as depooling. It was a pool asset, but we've been able to depool it. We have been able to ungroup it from the pool by making an election and calling it as short life. The short life asset will have its own column, like you see me preparing. Short life asset will have its own column, like you see me preparing. Short life asset will have its own column. Now, by placing it into a spare column, what do we have to do? We will have to claim normal capital allowances, normal capital allowances are claimed over its useful life. Normal capital allowances are claimed over its useful life. Normal capital allowances are claimed over its useful life. Means we will still be able to claim written down allowance year after year over to it. But by keeping it into a spare column, we will do it. Not that we will come to apply any special rate of allowance to it. We will still be able to claim written down allowance at 18%, at 18%, at 18%. But by keeping it into a separate column. Two possibilities are there. Short life asset is disposed within 8 years and not disposed within 8 years. Not disposed within 8 years. So if the short life asset is disposed within 8 years, we will come to work balancing adjustments. Balancing adjustments will arise, and you know those balancing adjustments in the shape of allowance or in the shape of charge. Balancing adjustments will arise. And if SLA is not disposed within 8 years, then what will happen? Tax written down value at the end of 8th year will be transferred to main pool at the start of 9th year, because it cannot be called as short life asset into its 9th year. So we have a job to do. We will be able to transfer it back to the pool at the start of 9th year. Whatever the tax WDV it has been carried at the end of 8th year. The moment the 9th year will start, at the start, it will be transferred back to pool and will become eligible for pool rules normally the way that we apply. There's no third possibility in it. Either it has been disposed into its 8-year life or not disposed in its 8-year life. Check this out. If SLA is disposed into its 8 years life, tax WDV at the transfer to pool at the start of 9th year, if not disposed. But balancing adjustments will arise if SLA is disposed into its 8-year life. Short life asset is an asset that has been acquired with the intention of disposing it in 8 years. Separate column is the one has to maintain. We have that application number 10 within which I can really come to demonstrate the idea of the way that it will be treated. Which application is it? Application number 10. So Delia has traded for many years, preparing accounts 31st of Jan each year. The tax WDV on the pool was 19,000 on 1st of Feb 2021. On May 1st, she acquired a new machine costing £15,000. She anticipated that the machine would last for 2 years, and she eventually sold it on 30th of September 2023. In July 2020, she acquired the general plant and machinery for 1195,000. One has to calculate the capital allowance for each of the year involved. So we will see the number of years are involved. So we will have to work the answers for all of those years are involved. 1st of Feb 2021 to September 2023. Maybe 1, maybe 2, maybe 3, whatever the number of years are involved. But we at least have to start ourselves from 1st of Feb 2021 to 31st of Jan 2022. I will have to maintain a column of AIA, pool, and the column of allowance. On 1st of Feb 2021, the pool starts off with 19,000. We'll have to maintain a column for short life asset also by leaving a bit of a space. Needs to construct the column of short life asset. Okay. On May 21, she acquired a new machine costing 15,000. She anticipated that the machine to last now. See that this is going to be a short life asset. And this machine can be used for 5 years, but she anticipates to use that for only for 2 years. And eventually, see, she has sold it. On July 2020, she acquired a general plant and machinery for 1195. That's a normal thing. So the value of the plant is 1195,000. I will match the AIA with by the maximum of 1 million. This is 195,000. This will be transferred to the column to which it belongs to, which is this column. And then comes the short life asset. I will go to write the value of this into a column to which it belongs to. And then we'll come to claim the written down allowance as normal. The total of this column will be 195,000 plus 19,000. The figure is 214,000. 38,520. 2,700 plus 38,520, it's 41,220. So even by keeping it into a spare column, we are not doing anything special. Just it has been kept separately and we are claiming the allowances over to that normally. The closing of this will become the opening of the next year. The closing of that will become the opening of the next year. A column of AIA, pool, short life asset, and allowance. One 75480 12300. 175,480 12300. Is this the year of disposal? I really doubt, because the disposal is September 23. So I will come to claim the written down allowance at 18% over to it. That's 315 175 175,480. The 18% of that is 31586. 31586. 12300. The 18% of that has to be 2214. Minus this, it's 10086. 31586 minus 175,480. That's 143,894. The closing of this will become the opening of the next year. 2214 plus 31586. That's about 33,800. The closing of this will become the opening of the next one, where now finally this short life asset is going to be disposed. The day of disposal is 30th of September, which definitely is happening. SLA disposed. Remember, when short life asset is disposed into its 8-year life, we end up working the balancing allowance or balancing charge. This looks to me we are going to get balancing allowance, since we are suffering the loss. 8786. This is the balancing allowance, which I have been able to get. And yeah, on the remaining balance, we will be able to work what? The written down allowance, and I can work. This balance will be used to work the written down allowance at 8. This one. Okay with this? So we have to keep it, the short life asset, in a separate column, and then we come to claim the normal allowances over the life. As you can see me claiming the written down allowance in this year also. And if SLA is disposed into its 8-year life, we come to compare the proceeds to its tax WDV to find the allowance, which is what we have got. There's nothing special about it. Just need to columnize it separately and respect it, that okay, if disposed in 8-year life, work the balancing allowance or charge. And if not disposed, whatever the closing tax WDV you have at the end of 8th year will be transferred back to pool at the start of the 9th year. That pretty much ends up the huge topic of capital allowance, full of computations. And I have taken the best care of that. This was the 10th application we have done. That by the time this topic is finishing, you already have been able to revise that process so many times. Every question on a rolling basis, consistently revising the way the column of AIA1 has to plan and match it up with types of cars, asset within which the owner has a private use, short life asset, small pool WDA, disposal of asset, cessation of business, short, long periods treatment. But that still does not complete the entire topic, since we are marching towards this thing that in the start of the topic, I told you we will look into that in the last. But that is a small explanation. Structures and building allowances are, they are a small little kind of information, which we can finish it off in the next 15 to 20 minutes. Main thing was capital allowance on plant and machinery. As you can see, all of the pages are on it. Just on the last page, this much knowledge we will have to learn in regards to SBAs, structures and building allowances, and followed by one application. So now we are going to take ourselves into the SBAs, structures and building allowances. Structures and building allowances. SBAs. Now, structures will take roads, tunnels, bridges, walls, while buildings will take factory, office, all of those business premises, retail premises, warehouse. And these allowances are on these things, structures and buildings allowances. You're not going to take me plant and machinery now. You're not going to take me down to the land. The cost of land is not permissible. Since even in accounting courses, you do not calculate the depreciation on land. So even in the tax, it will not be. It will not be. At what rate? 3% on the qualifying cost of structure and buildings. This 3% is on straight line basis. Means every time you have to work the 3% onto the cost, because you know that the straight line method is applicable to cost. It's not reducing balance method, so that you will take tax written down value to apply the next year's 3% at cost. Once you have finalized the cost, you come to apply 3% each year into it, like a straight line method. Becomes applicable from when the structures and buildings becomes available for use. Means this will require us to prorating. If the structure and building, they have been made available during the year and say for 7 odd months, then we must have to prorate that allowance down to 7 months. Like in accounting studies, if an asset has been held in the business, say for 7 months or 8 months or 9 months, you will have to not just work the allowance, but also need to prorate this into some months. If you look back into the lecture notes, nothing is much written more than to it. Structures and building allowances are available at 3% on the qualifying cost on a non-residential structures and building. Did I name anything over here that is residential? Is the factory building a residential building? Is the office building a residential building? All of these buildings are non-residential. Structures are non-residential. So if the word non-residential is used, these examples that I gave it to you before was itself the answer to it. I haven't named private accommodation in it. I haven't named any cottage in it. I haven't named any apartment in it. I haven't named any mention in it. Factory building, office building, retail premises, warehouses, and the structures will take roads, tunnels, bridges, and walls. These are those examples. Initially, whatever the cost that you have incurred, and subsequently, if it has been improved. Like in accounting studies, you calculate the cost of the asset by not just taking the initial value, but also subsequent capital improvements. Same way, for structures will take rails, walls, bridges, and tunnels. And that should not be rails, it should be roads. That's a wrong thing. We'll take offices, retail premises, factories. The qualifying expenditure should not include land, planning permission, legal fees, stamp taxes, repairs, and maintenance. But these are the costs that you also incur in relation to structures and building, but you should not be including that being the part of the qualifying cost. Land, permission cost, legal sort of cost, any sort of stamp taxes, and repair and maintenance cost. 3% annually on a straight line basis from the day the asset is brought into use, and will be prorated, like I told you. If it has been brought into use during the year at any point, then we will have to consider taking the months. Should not include the cost of land, planning permission, repair and maintenance, stamp taxes, and the legal sort of costs. Application 11, we can do that just to quantify. Definitely, this has to be kept separate. SPA is kept separate from the other assets qualified for capital allowance. Application number 11. Very rare you can expect to get a question on SPAs, but if you will get, it will not take any stuff more than to what you just have seen. Now, during the year ending it on to 31st of March, Cyrus incurred the following expense on a new factory constructed to use in his business. So it's a factory building, and they have provided with the list of all of those costs. Land of the factory building, leveling the land, factory building itself, and planning permission. So we will not go to take the two things. First of all, we will not take the land cost. We will not take the planning permission. Leveling of land we will take, because you level the land to construct a building. So it becomes the part of the construction cost of factory building. So leveling the land is allowed. Land cost is it's not allowed. The factory was brought into use on to 1st of October. That day is very much important for us to look in, and our year end is 31st of March. They want us to calculate the SBAs for Cyrus. If I will work the part A and working the answer for Cyrus, the year ends on to 31st of March 2022. The start of that has to happen on 1st of April 2021. So what is the cost are we going to take? That's going to be this one, 413000. and the day it has been brought into use. Factory brought into use. The day of that is 1st of October 2021. So how many months to run from that point of mark to this? There are about 6 months. October, November, December, Jan, Feb, March. October, November, December, Jan, Feb, March. October, November, December, Jan, Feb, March. So 413 triple 0, 413 triple 0 multiplied by the rate of the allowance, and then 6 by 12 factor will be used to get that answer. This is 413 triple 0, the 3% of it divided by 12 multiplied by 6, the figure has to be 6195. 6195. Okay. Part B. Explain the SPA implications of Cyrus and the buyer if the building is sold for 800,000 on 1st of Jan 2032. The buyer has the year end of 31st of August. So explain the SPA implications for Cyrus in the year in which it was disposed for 800,000. So they want us to answer the allowances that we have to work for the year of disposal. In which year have they disposed? The date of disposal is 1st of Jan 2032. Factory disposed 1st of Jan 2032. 1st of Jan 2032 is the day factory is disposed. So in which year this disposal date will be belonging to? The year runs from April to March. So that year will end on 31st of March 2032. Start of that has to happen on 1st of April 2031. Is it? So how many months this asset will still be held in that year of disposal? We can count it from the start. It's going to be April, May, June, July, August, September, October, November, December, 9 months. So before an asset was disposed, it has still been kept with them for about 9 months. So I will still have to work the allowance based on to the same cost on a straight line basis, 413,000, the 3% of that, multiply this by 9 by 12. Okay with that, 413,000, the 3% of that multiplied by 9 by 12, that's going to be 9293. 9293. Just 1 minute. Okay. So 413,000 multiplied by 3%, 9 divided by 12, the figure has to be 929. So both in the year of purchase and in the year of disposal, we must have to prorate, depending it upon the number of months that asset was being kept with them in the business. That is what they have asked me to. And they also want me to answer it from the buyer's perspective. So this is from the perspective of Cyrus. This is from the perspective of Cyrus. And this is from the perspective of buyer. Now, from the buyer's perspective, we will have to see the year end of buyer. The buyer's year end is 31st of August. And the year end for the buyer will be 31st of August, 32. This must be starting it on 1st of September 2031. And this is the day an asset was purchased by buyer. From the buyer's perspective, it must have been a purchase of factory. And the date of that will be the same. How many months to count in? Jan, Feb, March, April, May, June, July, August. 8 months. So noticeably, the buyer has acquired this asset for how much? 800,000. That should not be the cost at which the buyer will start claiming the allowance. The buyer will still use that original cost at which even the original buyer was computing the allowance, and that cost is 413,000. This is where you will have a chance of making a problem. Just wait. So this is where you will be having a chance of making a problem, because usually we use the cost in order to calculate the charge. So buyer has acquired that asset for how much? 800,000. In a normal scenario, you would have used this amount to calculate the charge of the depreciation based on to it. But no, the new buyer will even be using that original cost at which the charge was earlier being made. This buyer will use the same. So that is structures and building allowances that in the last part of this question, last part of this chapter, we had to finish it by, and we've been able to. Okay, no problem. Let's not forget what you have made out of this chapter. We've been able to work one thing which was pending from the chapter 4. It was one of the adjustment of category 4 that requires to have a deduction from accounting profits to arrive at tax adjusted trading profit. And that one adjustment was the whole chapter of computation that we have finished it by. That means our profits are now finally tax adjusted. Even after deducting the effect of capital allowances and structures and building allowances, our profits, now they have become fully ready to tax. Tax adjusted trading profits. Such a massive chapter, and the most difficult, most lengthiest chapter of our course was this capital allowance. Tons of the knowledge. Now you can come back to read this summary because you are done with all the detail. It's going to help you a lot since you have done the whole chapter in detail. A lot of things we have done and we have been able to complete ourselves with. Okay with that? Fine. Let's take a soft start of chapter 6 today. Mainly, we'll be focusing on to that the next week. Now, what this chapter is about, chapter 6, it's titled as Basis of Assessment. And you will have to understand, what does that mean, basis of assessment? Income tax. We are still under the banner of income tax and continuing with the topic named as basis of assessment. What this chapter is about. Remember, when we've started off with the profits of trading profits, we have started ourselves off with accounting profits. We've started ourselves off with accounting profits, within which the adjustments were passed. Many of those adjustments were passed. Many of those items were added back. Some of were subtracted in those 4 categories. Then, just recently, we have taken the effect of those capital allowances out of the equation. The figure of the profit that we get it in the end is called as tax adjusted trading profits. Is it or not? This is called as tax adjusted trading profits. It's called as tax adjusted trading profit. This is what we have learned back into chapter number 4. This is we have just learned in chapter number 5. After applying the knowledge of 2 of those chapters, the profits now have become ready. So the chapter 6 is about which tax here this will be assessed in. Which tax here will this be assessed in? This chapter is about. Which tax here this will be assessed in? This chapter is about. I mean, are we going to assess these profits into tax year 22, 23, 21, 22, or 23, 24? This chapter will provide us with the guidance of. So the title of the chapter is Basis of Assessment. What is the rule that one has to use on the basis of which the profits will be assessed in relevant tax year? We will go to learn that out into chapter 6. So it's a step forward. You must have to make yourself done with this first before being able to assess them into respective tax years. You cannot bypass these 2 chapters on the way and expecting to complete chapter 6. These 2 on the way will have to be worked first so that you reach up to this mark at least. Now, once the profits have become ready to tax, a final product is in your hand. Which tax year should I go to throw these profits in? Chapter 6 will provide us with the guidance. And I can give you a very simple example to make you. Suppose this is a period of account within which that starts on 1st of July 2022, ends on 30th of June 2023. The profits for this period are 1,000. The profits are 1,000. The profits are 1,000. Now these profits, not the accounting profit, these profits are tax adjusted. I do not have to say that these profits are tax adjusted. You should be keeping that in mind. The chapter 6, if we are applying, to the profits, those are already adjusted for tax. So it's obvious that these profits are tax adjusted trading profits. So to which tax year should I have to go and assess in? What is the rule to follow in normal circumstances? We have to focus on to the last day of this period. We will have to focus on to the last day of this period to see to which tax year that it belongs to. So to which tax year that it belongs to, I will mark it. I will mark it. And we'll go to assess all of these profits to this tax year. Okay with that? Focus has to be onto the last day of the period and see to which tax year that it belongs to, assess the profits within it. This rule is called as current year rule, or also called as ongoing basis. This rule is applicable into a situation where the business has not just started, the business has not just ceased, and it is just any other random year of the business. So we come to apply on routine basis current year rule. That's the first one we are done with. Current year rule, normal situation. Not the situation when the business has just started or just closed, because we have some special rules to work when the business newly starts and when the business ceases. But this is a situation where the business neither has just started nor just has ceased, but like a normal any other year of the business. Focus on the period end date and assess the whole taxable profits to the tax year to which they are related. That's exactly what I have been able to do over here. Application number one, we even can do on that to end up this basic rule. Alan prepares accounts to 31st of December annually. His recent taxable trading profits have been as follows. Year ended 31st of December 2021 and year ended 31st of December 2022. The profits they have also provided, the profits are given as 50,000 and 75,000 respectively. 50,000 and 75,000 respectively. I will have to focus on to the last day to see to which tax year that it belongs to, and will go to assess by all of those profits into it. That is the end of current year basis. But the real thing will start when we will take ourselves down to opening year rules, which is the main thing in this chapter to spend time on. As you can see, lots of rules are coming to our way. Long period, short period, long period has further two cases, short period has got further two cases. And for each case, we have a rule to remember and then application to do onto that. But this chapter can take about 1 hour or so. The next time we will be able to finish it in, maybe the half of the course will fully be on. Not lengthy, this chapter is, but whatever we will come to work will be difficult, will be tougher, but does not have a length. Whatever we will come, it will be challenging. We can finish this off into the next course by spending the first half of the course the next week by, and before we will be able to start ourselves with chapter 7. You have seen me completing the topic of capital allowance today, and it requires to have much revision within the same week. You have to, since after week you will start forgetting. Month of October is just about to start tomorrow, which is effectively the last month for our course preparation. After that, I have planned to leave you at your own. The revision courses are also to be planned in the mid part of November. Time has been running so fast. The past 3 months, we did not realize how quickly flown away. Coming month will also be. Have you got any plan in your hand ready for your revisions for this month? Or you're just not interested? Or you're just letting the time go and dragging this all to that last 1 week before the day of exam? Ask these questions to yourself. Do you have a plan in your hand at the moment for the next month? Or do you even plan to make that plan, or still entering it into a month of October without any such thoughts, the way that you have lived the past 3 months? Is this the time that I still have to say to you that start studying, start revising, start practicing, or you can also understand at your side what is good and what is bad for you, especially the time that we are left? Based on the plan that has been shared, we have been acting upon, and we are finishing the course according to whatever we have planned. My side will be done the way that I have planned. Since I've been following the courses, we have been taking the classes for all those past weeks. Even once we got the chance to take an additional class, we even have taken what was planned onto that day, we have finished it. And whatever is planned for this month, it will even be finished. Your side is the side that you should be more worried about. It's you ultimately at the end of the day have to be deciding to sit into exam, and must be your efforts be therein as more as I'm putting efforts in. Month of October is just starting. Step up if so far you have not. Take this weekend, tomorrow, the day of Sunday, to at least make a plan for the month of October. Just don't keep on living your life by still waking it up on Monday morning, going to the work, coming back home, Tuesday morning, going to the work, coming back home, Wednesday morning, Thursday morning, Friday morning, and then Saturday the course, and then Sunday, and then this way, even the next 4 weeks of the month of October will fly by. That concludes the course of today. When I will meet you the next week, we will continue with this chapter 6. And whatever we have planned to do into the next course, all will require to have your good revision, what we have done so far today. That is it. I will see you the next Saturday course to continue. Thank you very much.